Analyzing statements of cash flows is a critical component of financial statement analysis because cash flow information provides insight into a company's liquidity, solvency, operational efficiency, and long-term sustainability. While the income statement measures profitability using accrual accounting, the cash flow statement focuses on actual cash generation and usage during a reporting period. The program emphasizes that analysts use cash flow analysis to assess earnings quality, determine whether operations generate sufficient cash, and evaluate the company's ability to meet financial obligations. Effective cash flow analysis helps investors distinguish between accounting profits and real economic performance. Companies with strong and stable cash flows are generally better positioned to support growth, repay debt, and withstand economic uncertainty. One of the primary objectives of cash flow analysis is evaluating the quality of earnings. High-quality earnings are generally supported by strong operating cash flow, while weak or declining operating cash flow relative to net income may signal aggressive accounting practices or unsustainable profitability. The program notes that earnings quality is stronger when operating cash flow is close to or exceeds reported earnings. Analysts therefore compare trends in net income and cash flow from operations over time to identify inconsistencies. Persistent gaps between earnings and cash flow may indicate premature revenue recognition, weak receivable collections, excessive capitalization of expenses, or other accounting choices that distort reported financial performance and profitability. Cash flow analysis also helps analysts assess a company's liquidity and financial flexibility. Liquidity refers to the ability to meet short-term obligations as they come due, while financial flexibility reflects the company's capacity to respond to unexpected opportunities or challenges. Operating cash flow is particularly important because it demonstrates whether normal business operations generate sufficient cash to sustain the business without relying excessively on borrowing or asset sales. Companies with strong operating cash flow are generally better able to fund capital expenditures, repay debt, maintain dividend payments, and survive economic downturns. Analysts therefore evaluate cash flow trends carefully to determine whether the company can support future operations and strategic initiatives through internally generated funds. Free cash flow is another important measure used in cash flow analysis. Free cash flow represents the cash remaining after a company covers operating expenses and necessary capital expenditures. This residual cash may be used for debt reduction, acquisitions, dividends, or share repurchases. Analysts often distinguish between free cash flow to the firm and free cash flow to equity depending on the intended analysis. Positive and growing free cash flow generally indicates strong financial health and operational efficiency, while persistent negative free cash flow may raise concerns regarding sustainability. However, negative free cash flow is not always unfavorable because rapidly growing companies may intentionally invest heavily in expansion projects expected to produce higher future returns and long-term shareholder value. The analysis of investing and financing cash flows provides insight into management strategy and capital allocation decisions. Large investing cash outflows may reflect expansion, acquisitions, or modernization efforts designed to enhance future profitability and competitiveness. Financing cash flows reveal how a company funds operations and investments through debt issuance, equity financing, or internally generated cash. Analysts evaluate whether financing decisions are sustainable and aligned with long-term strategic objectives. Excessive reliance on external financing may increase financial risk, especially during periods of economic stress or rising interest rates. Conversely, companies capable of funding investments through operating cash flow may demonstrate stronger financial flexibility and lower solvency risk over the long term. Analysts also use cash flow ratios to evaluate company performance and compare firms within industries. Common measures include cash flow adequacy ratios, cash interest coverage ratios, operating cash flow ratios, and cash debt coverage ratios. These metrics provide insight into liquidity, debt repayment capacity, and operational strength beyond traditional accrual-based ratios. For example, operating cash flow relative to current liabilities helps assess whether a company can meet short-term obligations using internally generated cash. Cash-based ratios are often considered more reliable than accrual earnings measures because they are less vulnerable to accounting manipulation. Combining ratio analysis with broader cash flow evaluation enables analysts to develop a more comprehensive understanding of financial strength and risk exposure. Working capital analysis is another important component of cash flow evaluation. Changes in accounts receivable, inventory, accounts payable, and accrued liabilities directly affect operating cash flow and may reveal operational strengths or weaknesses. Rising receivables may indicate slowing customer collections or aggressive revenue recognition, while increasing inventory balances could suggest declining demand or inefficient inventory management. Conversely, growth in accounts payable may temporarily improve cash flow but could also indicate payment delays caused by liquidity pressure. Analysts examine these relationships carefully to evaluate operational efficiency, cash conversion cycles, and management effectiveness. Understanding working capital trends allows analysts to assess whether cash generation is sustainable and supported by healthy underlying business operations. Ultimately, analyzing statements of cash flows provides a deeper understanding of a company's economic reality than profitability measures alone. Cash flow analysis helps investors evaluate earnings quality, liquidity, solvency, operational efficiency, and long-term financial sustainability. The program emphasizes that cash flows complement the income statement and balance sheet by revealing how accounting profits translate into actual cash generation. By integrating operating, investing, and financing cash flow analysis with ratio evaluation and working capital assessment, analysts can identify strengths, risks, and potential warning signs more effectively.